Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at two strong buy Zacks stocks to consider adding to your portfolio with the market at new highs. But before we get into everything, I want to say remember to subscribe and leave a review wherever you're listening to your podcasts, and make sure to check out our new Zacks.com/promo page for looking at some of our services, portfolios, and more. So before we jump into the two stocks, I just want to quickly do a very, very brief market recap. So the NASDAQ and the S&P 500 both jumped to fresh records on Monday as the indexes continue to climb to new highs, as the story seems to be pretty much the same as investors continue to buy these tech dips we've seen in 2021, despite the legitimate overheating and inflation concerns, with the bullish sentiment during the low volume summer months appearing to signal that Wall Street is shrugging off those inflation worries and the possibility of rising interest rates as they look at historical levels. So even if the Fed is forced to raise rates sooner than they initially projected, U.S. Treasury yields are poised to remain historically low, leaving investors left to chase returns in stocks. Plus, the impressive and constantly improving earnings outlook helps showcase just how strong the U.S. economy is at the moment amid this grand U.S. reopening. So given this backdrop and the bullish resilience we've seen with the market pushing to new highs, investors likely want to remain exposed to the market because we've seen these dips where maybe people sold off and then they've already missed these rips back to new highs. So with that in mind, let's dive into two solid, strong buy stocks that might be longer term buy and holds at the moment. And we are going to start with Target. Target, which trades in the ticker TGT, for those of you who didn't know that, crushed our first quarter estimates back on May 19th, and it provided, as always, pretty upbeat guidance. So Target stock has surged to new highs since that report as Wall Street continues to dive into that big box retailer. So we're going to do a quick Q1 recap and then do more just broadly on why Target looks so strong. So Target's Q1 FY 2021 revenue surged over 23% to over $24 billion. This crushed our Zacks estimate and blew away the year ago period's 11% growth. So 23% growth on top of 11% growth in the first quarter of last year that got a little bit of that COVID boost. At the bottom end of the income statement, Target's adjusted first quarter earnings skyrocketed 525% to $3.69 per share, and topped our estimate by over 60%. So as I mentioned, just blowout first quarter results. The first quarter marked Target's third beat of 60% or higher in 3 out of the last 4 quarters. Target also provided strong Q2 guidance that called for mid to high single-digit comps growth and, quote, positive single-digit comparable sales growth in the last 2 quarters of the year. So continuing this strong comparable sales growth against what was already a really impressive COVID-boosted year that is really hard to replicate. So the fact that they're able to grow again is rather impressive for Target and shows just how strong the U.S. economy is at the moment. So since its report, analysts have raced to raise their earnings outlooks, with its FY 2021 consensus estimate up about 23% and its FY 2022 figure 17% higher. Target's e-commerce boom helped it thrive during the heat of the pandemic, and those same offerings have helped sustain its growth during this modern retail age and will continue to do as we come out the other end of it. Target's same-day offerings feature in-store pickup, drive-up, and a subscription-style shipped unit, along with its new age shopping push. The Minneapolis-based retailer has focused on more heavily on its in-house brands for fashion, furniture, food, and much more. Its various store brands have expanded and stood out because of the company's ability to constantly adapt and stay on trend while remaining affordable. These efforts include athleisure brands that challenge likes of Lululemon and its Good and Gather grocery brand, and many others. And its growing slate of in-house brands have helped separate Target from rivals like Walmart and Costco within some key demographics. Target's owned brands, so as I said, those in-house brands grew by 36% in the first quarter, so well above its overall growth, which company executives said was the strongest ever increase recorded. Target has successfully positioned itself as a fantastic one-stop shopping option and has been able to grow despite Amazon's constant pressure on the industry at large. So Target's Q1 comps jumped 23%, with digital up 50% on top of the year ago quarters, 141%. And its same-day services climbed 90%. So that digital growth is really continuing. And Wall Street is also focused on its impressive margins that help it stand out against many of its big box peers. And its Q1 operating, with that said, its Q1 operating margin came in at a, quote, unprecedented 9.8%, up from a very healthy 6.4% before the pandemic in FY19. Looking ahead, Target expects its full-year operating margin rate could reach 8% or somewhat higher to easily top last year's 7%. The company has been able to grow its margins despite its new offerings, since it's not reliant on separate fulfillment centers or warehouses. And its CEO, Brian Cornell, said on the earnings call, quote, the distinction between a store sale and a digital sale is largely irrelevant because our unique stores and hub model, more than 3/4 of our first quarter digital sales were fulfilled by our stores. So that's what I was talking about with that they don't have to go to these various hubs. They're just shipping it to you right from where the store is, the nearest store from your house. So Target's adjusted 2020 earnings soared 47% on 20% stronger sales. So just massive growth last year. And looking ahead, it's expected to post even more growth, even as it comes up against that unprecedented coronavirus boosted year. So Zacks estimates are calling for its Q1 FY 2021 revenue to pop another 9% to come in at over $102 billion to help lift its adjusted earnings by 26%. Target is then expected to post marginal growth again in FY 2022. And we could see those estimates climb even higher, since before its report, we were calling for similar sort of marginal growth this year, and now we're calling for 9% top line growth and 26% adjusted earnings growth. Target's post-earnings release revisions help it grab a Zacks rank number one strong buy at the moment, and 15 of the 19 brokerage recommendations that Zacks has for Target are strong buys, with none below a hold. So despite its market and industry beating run over the past 3 years, Target trades at a discount compared to its industry and Walmart at the moment. And along with its solid valuation, Target on June 9th announced that it raised its quarterly dividend by a whopping 32%, with its next dividend payable on September 10th to shareholders of record as of the close of business on August 18th. So still time if you're considering trying to get in on that next dividend payment. The increase helps showcase its strong financial position, and it raised its yield to about 1.49%, or about 1.5%, to match the 10-year U.S. Treasury right at the moment and crush its industry's 0.8% average. The stock has surged roughly 11% since its earnings release, and it closed at another new high, or it hit another new high on Tuesday morning of around $243 a share. The recent run has pushed Target above overbought RSI levels of 70. It's sitting at around 78 at the moment. So with that in mind, there could be some near-term selling pressure as investors take profit and let the stock that's already skyrocketed 100% in the past year possibly cool down. That said, nonetheless, longer-term investors don't need to worry as much about trying to time stocks, and it might want to consider adding Target to their portfolios. In the booming U.S. economy, it looks poised to help retailers as consumers continue to spend. In long-term, these one-stop shops, such as Target, which has really helped stand out in a crowded market, and it's prepared for the e-commerce future, and it pays a strong dividend with good margins, really does seem like a solid pick for any diversified portfolio to hold on to for years and years and years to come. So now we're going to move on to a totally different company in a totally different industry that also is a strong ranked Zacks stock at the moment, and that is Intuit, which trades under the ticker INTU. It operates a relatively straightforward business in a somewhat crowded cloud computing in software as a service space, which does help it. The company offers a variety of financial services, and it's most famous for perhaps its online tax software, TurboTax. Intuit also sells software geared towards accounting, small business money management, and personal finance, which includes QuickBooks, Mint, and Credit Karma. These offerings are now nearly indispensable to many everyday consumers and businesses. And in this broader business software push and consumer software push, companies of all shapes and sizes, and as we said, everyday users, are now relying heavily on various technologies. And there's really no going back from this. Once you've locked in these services for your business, and even if you've decided to use TurboTax for your own taxes, it's unlikely you're going to go back to filling it out by hand anytime soon. So the company boasts roughly 100 million customers worldwide, and it topped our Q3 estimates on May 25th. and it raised its full year guidance at the time. So its Q3 revenue jumped 39%, with its small business online ecosystem up about 28%, while its consumer group revenue popped 34%. So looking ahead, Zacks estimates are calling for its full year revenue to jump over 22% this year to $9.39 billion, with it then expected to climb another 16% next year, all the way up to $10.85 billion. These estimates would extend its streak of annual revenue growth between 11 and 20% to 7 straight years. So this shows the stability of its business model and just that unique value that something like TurboTax and these financial services-based softwares provide. Then on the bottom line, it's expected to grow its earnings by 19% this year and then another 16% next year. And since its earnings release, the company's full year earnings outlook has jumped by 12% for this year and then another 11% for next year. So that positive bottom line revisions and this outlook has improved, as we mentioned, to help it land a Zacks rank number 1 strong buy at the moment. And like Target, the overall brokerage recommendations Zacks has of the 18, 13 are at strong buys, with nothing coming in below a hold. Intuit stock has also climbed 70% in the last year and 340% in the past 5 years to crush the tech space's 190% climb. And the stock popped again on Tuesday as it sits right near its all-time highs. The company also pays a dividend, and Intuit's valuation is hardly stretched, even though, as we just mentioned, it is trading right at those highs. So like Target, Intuit is trading above overbought RSI levels, so there could be a near-term pullback. But in the end, Intuit's platforms aren't likely to go out of style no matter what the world looks like in 5 years or maybe even 5 decades. So both of these stocks, even with them trading right at their highs in the market at fresh highs and seeming maybe a little overbought in terms of that RSI level, longer term investors, as we've seen in 2021 so far, don't need to try to time the market because it can cause you to miss out on these rips higher, as we've seen investors in Wall Street continue to buy these dips amid these low interest rates that will continue to stay low even if the Fed is forced to raise rates. And we've seen that these bullish sentiments have continued to shake off any of these inflation fears at the moment. And both Target and Intuit are businesses that are going to be pretty invaluable no matter what's going on. Target is as we said, a one-stop shop, and Intuit's offering something that, as that phrase goes, taxes are never going to go out of style. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.